Crypto markets fail to recover alongside equities, even as trade war rhetoric gets dialed back down. Long-term holders of crypto are selling, and demand from digital asset treasuries and ETFs seems to be waning. Put Skew and Vol, whilst off the highs, are still signaling caution ahead of CPI data due this week. All this and more in this week's Crypto Options Unplugged. Welcome back to Crypto Options Unplugged, everyone. I'm Imran Larka from Options Insight. I've got man Dave from FRNT. It's just you and me today, mate.
I know, just the two of us. Lots to discuss as well, I think. So
yeah, markets have been interesting. Lot of news flying around, a lot of narratives flying around. Hopefully you can help us break that all down in a masterful way that you do.
I hope so. I just think it's a really, really tricky market at the moment. I say we'll get into it, but I think there's a lot of different cross currents that we're at an interesting sort of juncture and trying to decipher where the next 10% is. I don't think it's easy. So yeah, it's interesting. So it'll be good to get into it with you and get your thoughts. Yeah.
So first, I mean, the big thing that kind of has kicked off a bit of volatility in markets was obviously the China trade war stuff again. Yeah. But some pretty quick backtracking in terms of the rhetoric coming out of Trump, right?
Yeah.
And they've got meetings coming up this week, next week, whenever it is, with a 1st November deadline for when these tariffs are supposedly going to kick in if they don't make a deal.
Yeah.
But it's weird because equities really seem to have priced it out. Like this is fine.
The taco trade,
VIX spiked to 29 and it got all the way back down to like 18 now. So it's saying nothing to worry about, right? Whereas, crypto's struggling. So I feel like crypto must be moving for other reasons than this kind of dynamic.
I mean, I do kind of feel that like crypto and Bitcoin, it feels like it leads risk a lot, I think. And I think it can be more impacted than I think equities, as I've been saying, have been underpositioned. So I just think there's
every dip just gets bought in.
Yeah, there's a mechanical grossing up of risk because markets are underweight. If you look at like a lot of hedge fund performance, like massively underperforming sort of benchmarks.
That's because every time it dips, they actually sell it and they try and jump on the short trade.
Yeah,
and then they get squeezed the week after.
And I think everyone just got everything like completely wrong in April. Thought Trump was serious about the tariffs, and all the impacts that would have. And in fact, we still haven't really seen much feed through from the tariffs that have gone in place. So, growth, Joe, when you're running this fiscal dominance as well, I think people forget that's in the background, right? I mean, so you go back to April and actually Besant was still pretending that they were going to actually try and get spending and everything under control. Now they've completely sort of flipped on that and they're still running Biden level deficits north of 6%. So it's really hard to have like the recession that everyone thinks is coming, and there's some massive offsets to some of the maybe negative impacts that tariffs would otherwise have. That said, we are seeing a slowing, I think, and that's...
Although we haven't had any data out of the US government.
We
will get CPI though this week.
I think what's really interesting at the moment, there's a lot of kind of conflicting signals coming out of markets. Like if you were to look right now at oil, even look at like 10-year yields, which are breaking down, oil's breaking down, that kind of looks like recessionary type slowdown fears. I still think, for what it's worth, until proven otherwise, we feel very much in that Goldilocks scenario of slowing, not collapsing growth. Like I don't think we're going into recession anytime soon. Slowing growth with inflation that's high, but not accelerating. So basically, we've got all the conditions for the Fed to keep cutting rates, which will be a nice little tailwind that keeps risks sort of going higher. But you've got certain market signals there from oil, maybe from rates that are saying maybe there's a bigger growth issue.
What sort of stuff going on in the funding market? Because there's been a bit of noise in there, right?
Yeah. So this is my biggest concern right now. And again, I just want to be really clear. I still think this bull market is still very much in train. I think we run into the midterm elections next year. So I don't think we've seen the peak in Bitcoin or crypto for this market at all. I don't think we've seen the peak in equities. But you're kind of looking at which point would we have a decent correction. Obviously, we had one back in April, and are we due another one? For me, the path was built around, we've been talking about obviously like rates and liquidity, that kind of all that matter in many respects. And we've had since early 2023, you've had this drawdown of the RRP. So there was $2.3 trillion of cash, right, parked in this facility with the Fed, right? And as kind of both appetite for risk has kind of come back, but also because of the deficit that's been funded by this kind of rotation towards treasury bills that allows that, particularly in the money market funds that would have otherwise placed that cash like at the Fed, that's come out to sort of buy all these T-bills, right, in search of just like that slightly higher yield. So we've had this rundown of like $2.3 trillion of cash flowing into the market, and that's why I've been like so bullish for so long. Now the playbook in my head for this year was right. We still had plenty of room to go on that, so we're probably going to still keep going higher and everything. The RRP is now virtually at zero. I think it's got 4 billion or something left in it, but it's pretty much at zero. So that cash is no longer able to sort of bring funding into the market, right? So now it becomes right, where does the money come from next? So you've still got banks sat on a lot of reserves, right? And the Fed talk about like ample reserves, which is a little bit of a nebulous concept, but and ample reserves being so that they've got sufficient reserves to sort of fund daily operations, and that any slight reserve changes doesn't mean the Fed are having to do too many things to keep rates in line with where they set Fed funds. Does that make sense?
Yeah.
Firstly, so the question is now, you know, when does the excess reserves that can fund all this bill issuance and sort of fund like repo trades and all this, which the banks are needing to do, when does that start to be depleted? In which case you start to hit all the funding problems that caused the Fed to, that we had in like 2019 when repo rates spiked, front end rates were spiking, risks getting hit, and then the Fed ultimately have to come in and do something. Now what's been going on since the RRP's hit zero, because the banks are the ones now having to kind of essentially do all the lending, you're starting to see sort of what they call the SOFR rates, the secured overnight financing rates, start to climb up, which is kind of like a signal to a lot of people that there could be some sort of tightening of liquidity in the system. Okay. So I actually think that is impacting Bitcoin, because I think as the ultimate liquidity barometer, there's signs that liquidity is becoming a bit tighter. Now, not because I still talk about global liquidity is rising. You've still got a global rate cutting cycle. You've got all these other kind of factors that ease liquidity. Dollar's still in a downtrend. You know, weaker oil, all these things are good for global liquidity. China is sort of pumping a lot into the system. So the amount of global liquidity is still looks fine and has been rising, but it's when the system like liquidity starts to just sort of freeze up a bit and clog up, right? So you're seeing these overnight funding rates essentially start to rise a bit. You've also seen another, and I don't want to get too technical and sort of bore viewers, but another tool that the Fed has is, so they try and maintain rates, right? With when you've got like pressure on rates coming lower, that's what the RRP does, right? And they pay interest on bank reserves, right? So what that means is if there's all this cash sloshing around in the system, buying up sort of bills and front end like interest rate products, that's going to put pressure on yields down. So if you're the Fed trying to keep rates up here, right? So then you go, right, well we'll pay you higher rates, so therefore the money goes into there, and then it allows it kind of arbs out that, you know, those rate differentials in the market. So then rates in the market go up and in line with where at the front end where the Fed are trying to set them. Okay. On the flip side, when funding becomes tight and cash is tight, and then sort of rates start to go up, then the the Fed have a facility whereby they essentially lend cash in return, like kind of like repo the other way. But they essentially lend the cash out, right? And to sort of keep a lid on rates. Now that window, and it's more expensive to use, and there's limits on who can use it and all that stuff. But that window is starting to be used again
by the banks.
By the banks, yeah.
Right.
And I think it was last week there was like 6.5 billion that was sort of taken from that window,
and it hasn't been used in a long time.
No, exactly.
Okay.
And not in any material amounts. So
right.
so
that's a sign of
that some banks are struggling to get some funding.
Okay.
Right?
Okay. First signs of that, basically.
First signs of that.
And then what about all the nonsense that happened with regional banks last week? Like the sector was down 6% in a day. What about that?
Yeah. So regional banks under pressure. You had 2 banks that reported like sort of bad loan losses, but that looks like it was more to do with sort of some fraudulent behaviour and
is that contained? That's not like a systemic
and
problem.
it seems contained. But again, there was just regional banks come under pressure, and I think all these things have just combined with. Hang on, we're talking about these SOFR rates going up. We're talking about returning to this Fed window and borrowing cash. Banks are struggling to find money. Now you've got regional bank stress. And then what I don't think helped was you had Jay Powell talking about, so the good news is he's basically said they're going to end quantitative tightening because he's seeing all this going on and he knows that they have to end that. And he kind of alluded to that there's signs of pockets of tightness of liquidity in markets. And I just think you've had this whole thing, which I think really spooked markets last week. And things look like going into Friday, things looks like they were
but it
looking
spooks
pretty.
Markets. It spooks markets for a day, and then markets don't care.
Yeah, and then we got into it. So I think like just to kind of sum up where I'm at with it, like I think there are some underlying signs of some stress in the funding markets, and I wonder if that is partly impacting sort of Bitcoin from just liquidity. And what I will say is I've spoke to some people that I know that work on bank funding desks, and their kind of view on it is there's no real signs of huge stress to worry about yet. There's some little pockets of illiquidity, but nothing serious. Like
not yet.
Like I don't know why people are making a song and dance of it because there's nothing. But it's something that everyone's kind of. But it's interesting. We know these things can turn really quickly.
Yeah, because I mean, just anecdotally, like I remember being on a bank's trading floor during the, it was in 2010 when Greece was having a problem basically, right, and they were potentially going to have to leave the euro and stuff like that. And the speed at which these things can turn, where everything looks fine and there's nothing to worry about, and there's a few people talking about it, but look, the markets don't care. Just suddenly, oh my God, all hell's breaking loose.
Yeah.
I mean, that period of time is so short. So I think even the people on those desks, unless they're specifically out there looking for the problem, they might not see the problem until it's already quite bad, basically, right? That's the only thing I
and like people have pointed out like this, like. So, like SOFR spreads trading over Fed funds is kind of quite normal given the RRP's tapped out, right? So you go, well, that's of course because like for banks, it's like, well, like if I can just park money with the Fed and earn like interest on bank reserves, then I'll do that. So I need a slightly higher rate.
You need an incentive to put it anywhere else.
So it's quite a natural thing. But then others have pointed out that actually that trend of that sort of rising SOFR rates above Fed funds has typically come before we had like the repo blow up, before we saw problems in 2020. So it has been a kind of forerunner. And I think this is where, and lots of, smart people that I chat to seem to disagree on this and whether it's an issue or not. But I kind of think whilst that uncertainty's out there, that's probably just holding us back a little bit. On top of all of that, we obviously had that huge liquidation event in crypto a couple of weeks ago.
Yeah, so we washed out a lot.
It's kind of destroyed a lot of capital in the system, and that's just going to take a time to digest itself, work itself out, and to sort of come back in and start flowing again.
Yeah, so whilst you're still obviously bullish for a long term, are you more cautious now?
I am cautious, yeah, and I say that with a sense of like this market wouldn't surprise me if Bitcoin's back at its record highs in a couple of weeks, but I kind of
But it might also be at like 85k.
Yeah, and definitely, and this is where we need to get into what you're looking at, because I definitely, it's not time to be taking off your downside hedges, I wouldn't say.
No, definitely not. It's funny, I helped one of my clients put on a hedge on Ethereum yesterday, actually, one of my consulting clients, and he was like, yeah, whilst I'm bullish as well, I do want to hedge part of my holdings. So we ended up putting a risk reversal on ETH. So in terms of the hedging side, I mean, Vol has come back a bit in the front end. So it had spiked, obviously realized it spiked, Vol had spiked, has all started drifting back down, particularly Ethereum. Ethereum's lost about 10 vols in the front end as that's kind of normalized a bit and kind of found a level. Skew got really, really steep in the front end. It got to like over 10, probably 12 vols in Bitcoin put skew for the 1 week maturity. It got to like near 15 on ETH. So it got really, really steep. That has come in as well, probably to about 4 or 5 again in the front end. Ethereum skew does still flip into call premium if we go out to sort of December. So still a bit of bullishness there in that longer dated Ethereum curve. But yeah, I mean, I think my hedges, the way, I'm certainly not looking to exit my hedges just yet. I think looking at the chart, there is potentially still some downside, maybe 100k, maybe even a bit less than 100k on Bitcoin. So I'm not in a rush to unwind any puts just yet. Calls though, if you did manage to sell them in that 130, 140k area, as the market's dripped down and vols dripped down as well, you can buy those back now. So I have bought some calls back on the 140 strike that I was short in end of November, because I basically made most of my money on those already. So I can buy them back. And if we get a bounce, I can resell them again. That's the beauty of that, right? You can trade around those. But the puts have kind of ballooned a bit in value. They're giving me a decent sort of 50% delta on them, which is kind of what I want from them. If we go 100k or sub 100k, then I would consider rolling them out maybe to December in lower strikes, maybe into a put spread if vol spiked quite a lot and I don't want to buy too much vol. Maybe I'll roll them into a December put spread just to keep a hedge in place of some sort, but lighten up on the delta of the hedge, because I've got an intrinsic on my November puts basically. So it's kind of where my head's at on the hedging side.
And I guess a question I've been asked in the last week, and it's funny. Someone accused me of being a bear on Twitter. Can you imagine?
They don't know you very well.
No, and like, some say that, do you feel you've got the macro wrong? Because of still, coming into October, still like very bullish, and I'm not. I don't think so. In terms of not huge amounts change on that side of things. We're still in this global rate cutting cycle. We've still got these positive tailwinds from from the dollar downtrend, from oil. And the same rising kind of global liquidity. You've got, when this fiscal dominance story, all these things are really positive for risk generally and for crypto. I think what's changed over the last couple of weeks, obviously the Trump China thing, that was a story that had gone away, and now we're kind of having to think about that again. I'm always a fader. I'm a believer in the taco trade, and I think you always fade it, but still, as a risk manager, you have to consider it because headlines could come out any moment. We've got this 1st of November deadline. Now you can see like markets are more comfortable with it. But again, I sometimes think we do forget that crypto is still higher beta. And so that tends to, like, we think higher betas, if equity is going up, then we need to be going up. But actually, if you think of it higher beta to risk and the underlying risks out there, that might be sort of keeping us there. And then, I think these funding issues, I felt, and I might still be right on this, but I felt there was sufficient excess reserves in the system that we wouldn't run into some of these issues now. And there's signs that we've just kind of run into those issues. And in which case, for me, that could be a game changer. But again, and there's smarter minds than mine out on this. It might just be a bit of nothing. And the other thing is the fact that the Fed and Jay Powell seem to be very aware of it. So if they're on top of it and if they're quite proactive, and I say he basically said last week they're ending QT. So again, which feeds the narrative of liquidity is going to get easier.
So we're going to hear probably more about that in the FOMC meeting next week. Yeah. Right? So that might act as a bit of a catalyst for markets moving as well.
Yeah, Nick Timiraos, the Fed whisperer. He put out something yesterday on Twitter that I thought was interesting, because he kind of alluded to the fact that like bank reserves as a percentage of bank assets has dropped below something like 13%. And apparently that was one of the levels that one of the Fed members said that was like below that's where we kind of think that things would be more of a concern. And I just wondered, is he trying to signal to everyone that they're going to end QT at this meeting? So I think there's a real chance they do. Now, again, like on the face of it, that's going to be sort of bullish for risk. Like the question for me is, like, if we get these funding issues, I think it will take more than the ending of QT, but maybe the ending of QT just, kind of prolongs it. Eventually, the Fed are going to have to come in and do some sort of liquidity provision, some sort of, market operation that we'll all be arguing, but it's not QE and it won't be QE technically, but from a liquidity standpoint, it'll have the same impact. The question for me is, will Jay Powell wait to see like the whites of the eyes of the funding problems before they act, or will he preempt it? If he preempts it, then we just go up and we digest this moment and we go up. But that's why I'm in a little bit of I could see us going one way or the other. They clearly are.
The ultimate destination is probably higher, but the question is, how bad does it get first?
Yeah, the other thing is, it was only a couple of weeks ago when all the suits on Wall Street were talking about the debasement trade. Which I've been talking about since forever. That trade is still very much in motion.
Although they're not really, people are saying that gold is the ultimate debasement trade, but Bitcoin's still like a tech-related risk asset, basically, right? But tech's still doing fine as well. So it's just...
But the debasement trade, everything's going up in dollar-based terms, right? And fiat terms. I won't single out the dollar.
So speaking of going up, do you think, though, there's probably more upside in things like Solana and ETH, though, than Bitcoin? So if we do finish this correction here, or maybe 5-10% lower, whatever it is, and we do get a year-end rally, like we often do, right, in risk, do you think you'd want to have some of the higher beta stuff rather than Bitcoin? Because, Solana, if you think about it, it's got potential catalysts there, right? It's got potential ETF approvals. It hasn't really been embraced by all the banks and the TradFi yet, whereas ETH kind of has, with the narrative at least, because of all this kind of build out of stable coins and tokenization, and all this stuff's going to happen on ETH.
Yeah.
So I feel like Solana's got a spark there that could kick off a rally, and I wonder whether that's where you want to actually any additional beta that you want to have to the crypto market beyond what you're hodling, right? If you want to use optionality or something like that. Kind of wondering whether Solana's the place to be.
Yeah, because what I think is going to ultimately happen is the Fed will end up like flooding this thing with liquidity at some point. They're going to start off ending QT, and then if we start to hit up some of them constraints in terms of excess reserves and whatnot, the Fed will start providing liquidity, and ultimately that's when you'll see the money flowing out of the risk curve. The other thing as well is. And I know our friend Raoul Powell's done some really good work on this, and the guys over there around like the business cycle and how he's the banana zone and how that responds to the business cycle. There are actually signs, despite me saying about this slowing US economy, there are signs that we're starting to bottom out here. Like ISMs and PMIs are actually showing signs of picking up. They're still not accelerating. You still got like manufacturing and ISM has been in contraction territory, but there's signs that it's moving higher. So going into next year, you could have a combination of the Fed providing liquidity and the global business cycle starting to pick up, and that's when you're going to see all those higher betas like Solana, ETH, SUI, they're all going to absolutely fly. So
do you think a melt up in risk is more likely in Q1, or do you think a melt up in risk is more likely into year end? That's the big call I want you to make.
Yeah, if you'd asked me a little while ago, I generally thought we were going to like pump pretty hard, given like some of the seasonalities into Q4, and I still think it's possible. But I think we might be in for a choppier period, and then like into next year, then you start to
Where
see a
people
proper
have more risk appetite and they want to strap it on again.
Yeah, and I think the big blow off top and everything comes just before the midterms next year. So
what's that in November?
In November, yeah.
Yeah.
So you probably, if you want to sort of take some risk off, like it'll probably be ahead of that, and sort of trying to time that. So that's kind of how I'm looking at it. I think caution in the short term, given some of these dynamics, not bearish. I don't think anything's changed. And again, I think the other thing for me is that all of this, the fact that we're talking about the Fed and excess reserves and needing to end QT, not because of anything that's going on in the economy, but because of what's going on in funding markets, it just goes to show you that this whole system still relies on ever more liquidity and essentially money printing, and that is why the debasement trade will never go away.
Never go away, yeah.
So it's just about navigating the periods of volatility through that.
All right, I think that's a really good place for us to end today's show. Cheers, mate. Cheers for talking us through your thoughts. Remember, like and subscribe, and we'll be back here next week with a special guest. So see you next time.